Ladies and gentlemen, good day and welcome to IG Petrochemicals Limited Q3 FY26 earnings call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. This conference call may contain forward-looking statements about this company, which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Pramod Bhandari. Thank you, and over to you, Mr. Pramod.
Today, on the behalf of IG Petrochemicals, I would like to extend a warm welcome to all the participants. We are also joined by SGA, our investor relation advisor. We trust that everyone has had an opportunity to review our financial results and the investor presentations, which were uploaded on stock exchange as well as company's website. During today's discussion, we will briefly begin with a quick overview of the recent industry development, provide an update on the IGPL financial performance as well as the project progress, which will be followed by the financial highlights for the quarter. Coming to the industry, the Indian chemical industry continued to operate in a challenging environment shaped by the combination of factors including ongoing geopolitical developments, volatility in the crude prices, rising global trade and the logistic cost, subdued demand from the key Western markets. These headwinds have impacted the performance of the major chemical companies across domestic as well as international market. IGPL is also not entirely immune to these pressures. Companies with a higher dependence on the import of raw materials, particularly those sourcing the raw materials such as Europe, China, have forced competitively face the greater challenges. Additionally, the players with a significant exposure to the US market are impacted by the tariff-related uncertainties. However, following the announcement of the US-India trade agreement, uncertainty surrounding the tariffs have been moderated. Further, the recent development around the EU free trade is also expected to open up the new opportunities for the industry over the medium to long term. While certain downstream segments experienced temporarily softening in demand in earlier quarters, the current trend indicates a healthy demand revival from various end-user industries. The impact on IGPL was relatively limited. This is primarily due to the localized customer base. Majority of our customers are located within radius of 200 to 300 kilometers from our facility, providing the logistic efficiencies as well as demand stability. Although IGPL doesn't directly export to US, however, some of our customers of downstream industries cater to the US demand. About IGPL continued to stand on a strong foundation, built our focus on the operating efficiency and cost leadership. We are one of the lowest cost producers of phthalic in India. We are the largest producer of phthalic in the domestic market and second largest producer of phthalic in the global market. Over the decade of focused efforts and continuous improvement, IGPL has developed a strong manufacturing excellence, ensuring a consistent and reliable supply of high-quality products. In addition to phthalic anhydride, our diversified product portfolio includes maleic anhydride, benzoic acid, and DEP, which cater to the broad range of industries. We expect this product to meaningfully increase their contribution to the company's overall financial performance over the next 4 to 5 years. Particularly about the Q3, our performance for the quarterly was impacted because of the compressed margin, lower realization of phthalic, as well as soft pricing for the downstream products. These prices pressure largely affected our revenue as well as margin during the period. In addition, the profitability was also impacted by the higher cost inventory built-up, which has been carried forward from the earlier period. From a balance sheet perspective, the past quarter we had also converted most of our euro-denominated debt into the rupee. So that has significantly saved us in terms of the currency fluctuation. And we also repaid a significant portion of our outstanding loan. So this initiative has helped overall reduce the forex exposure and strengthen our overall financial position. As a part of forward-looking strategy, we are continuously focusing on the upgrading our key equipment and improve plant reliability, ensuring we are well positioned to capitalize on the future growth opportunity. On capex front, our advanced plasticizer project is progressing well, and expected to achieve the mechanical completion by the end of March 2026. The plant will have an initial capacity of around 75,000 tons, which can be later on scaled up to 1 lakh tons. The facility will be manufacturing a wide range of plasticizers, including DOP, DINP, DBP, and DIGP, which will captively consume approximately 30 to 35,000 tons of phthalic anhydride when operated at optimum capacity, thereby improving the overall value chain and integration. In parallel, we are also doing the debottlenecking of our DEP plant, which will increase the capacity of DEP from roughly 8,000 tons right now to 12,000 tons by the end of March 2026. IGPL is also taking concrete steps towards green chemistry and sustainable circular economy. As a part of this, we are planning to set up a compressed biogas plant at Karnataka. The project is expected to generate the revenue from sustainable resources by reinforcing our long-term commitment to the environment. CBG project is under implementation and is on track to achieve the commercialization or mechanical completion by the end of the June or July 2026, while the pyrolysis plant is expected to be on schedule. Along with these initiatives, we remain focused on enhancing operating efficiency, lowering our carbon footprint across our operations. We are steadily increasing the integration of solar power and other renewable energy sources at our facility, which will support sustainable and long-term cost optimization. In addition to, we are also beginning a phase transition from the conventional fuel, including LSFO, diesel, to the natural gas. This shift is expected to save the cost over the period of time, will also improve the energy efficiency and reducing the emissions, thereby aligning our operational objective with the broader sustainability commitments. We believe that the period of subdued demand for the phthalic anhydride is behind us. Price level across the key products appear to have bottomed out. Looking ahead, we expect to have a gradual improvement in the demand from end industry, supported by the normalization in the market condition. Additionally, the recent developments such as US-India trade agreement, EU-India trade agreement present meaningful opportunity for the chemical sector. These initiatives are expected to enhance the market access and improve competitiveness and support the export-led growth. For IGPL, this evolving trade environment also open up the opportunity for potential revenue stream, positioning the company to benefit from the global demand condition will improve. Overall, considering the favorable global environment and anticipated demand recovery, we remain optimistic about the outlook for the coming quarter with a strong operational capability and integrated product portfolio and disciplined capital allocation. IGPL is well positioned to capitalize on these opportunities and drive sustainable growth. For the quarter ended 26, total revenue was 471 crore, reflecting a 17% decline, primarily due to lower realization and impact of high cost inventory. However, the overall sales volume has improved by more than 10% compared to the last quarter. Revenue contribution from the non-phthalic business was about 41 crore. Export contributes 15% to the overall revenue, which we have expect a significant growth opportunity going forward. Gross profit was 86 crore, EBITDA was 16 crore, mainly impacted by the compressed margin, high cost inventory and lower realization of the Maleic Anhydride. For the quarter, company has reported a loss of around 7 crore rupees. Total revenue for the 9 months was 1424 crore. The non-pen business for the 9 months was 114 crore. Gross profit was 303 crore and EBITDA stood at 56 crore. The total loss for the 9 months ended of 14 crore because the first quarter was also having a loss, second quarter was profitable and third quarter again the 7 crore loss. Overall profitability was impacted because of multiple factors, inventory cost adjustments, M2M charges for the forex as well as the compression margin. With this, I conclude my presentation and open the floor for question and answers. Thank you.
Thank you very much. We'll now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Riya from Equitas. Please go ahead.
Thank you so much for giving me the opportunity. So I will want to ask, since we have all the 5 plants running, what was the capacity utilization this quarter and what would be the kind of volumes we have done?
So typically, we are operating right now 4 plants, not 5 plants. And also one of the plants was shut for one and a half months. So for 4 plants, the capacity utilization was around 80 to 85%.
And why was the fifth plant working only for 1.5 months?
That was some technical snag that need to be changed. Otherwise, we intend to operate only 4 plants, but there was some technical issue. Because of that, it was shut for around 20-25 days. But again, it has started in December. Overall sales volumes compared to the last quarter has improved by more than 10 to 12%. It was more than 51,000 tons.
I think last quarter also we had some maintenance shutdown, right?
Last quarter was there was a change in the catalyst. We have 5 plants, and every year we need to take 2 plants for the change in catalyst. Every 2 to 3 years, we need to change the catalyst.
Yes, but however, every quarter there is 1 plant or so which is under maintenance or not.
We are operating 4 plants, and in that 4 plants, one or two plants need to shut down for change in catalyst. 5th plant is expected to start in line with the plasticizer.
Okay, 5th plant will only start with on the liner and the plastic this March.
Which is March, April, yeah. When plasticizer production will start, because that plant will cater 70% of the requirement. 70% of that plant production will go to the plasticizers.
Right. Also in terms of spreads, what are the current spreads? Also, I'm understanding that since last 2-3 quarters on the call, we have been mentioning that it is going upwards of 100 to 150 range. However, it is not reflecting in the margin.
Yeah. It is. Last quarter was, I think you can say that for last 9 months, it was the worst quarter, where the margin is compressed to around $50 to $100, which was the lowest. And that also the impact of the lower realization from the product, the higher cost of the orthoxylene, which has compressed the margin. Second, the reason is the lower realization, because $670 was around Maleic Anhydride rate, which has a revenue of around 11 to 12 crore, while we were expecting 15 to 18 crore every quarter. So that December quarter seemed to bottoming out all the margins. Since then, the prices has gone up from 80 to 83 rupee to 90 to 93 rupee. Now, there is an increment in the
Maleic or Phthalic?
Phthalic. So
80 to 90.
December quarter seems to be the bottoming out of most of the product prices as well as the margin. In Jan, Feb, we have seen very good improvement in overall margins.
Okay. Could you help me in terms of dollar terms, what are the current spreads right now?
When you are talking about the market margin, it's between $100 to $120. And IG margin is generally $40, $50 or $60 higher, because the operating efficiency, Maleic, benzoic acid, all advantage if you consider, then you need to add around $70 to $80.
Yeah, so earlier I think this number was like, I think last two, Q2 and Q1, I think Q1 you had mentioned that the spreads were around 100 to 120 levels only.
100 to 120 was right when the Maleic prices was very good. Now that 100 to 120 moved to 60 to $80 because of the decline in the Maleic prices. Because Maleic realization in our case is directly added to the EBITDA.
Right.
The Maleic prices has gone down significantly by, I think, like 20-25% in last 6 months.
Okay.
Today the Maleic is stuck around 600.
Are reducing since last 1 year only, right?
Actually, historically, if you look at, Maleic was around 20% higher than Phthalic. So
Right.
suppose Phthalic is $1,000, $1,050, Maleic is $1,200. Ideally, in last 20 years. But in last 1.5 or 2 years, the Maleic is 20 or 30% lower than Phthalic. If Phthalic is 150, Maleic is 670.
Right.
So that has impacted the overall age of our $100, $150 is reduced to $60 to $80.
Right. So my question is that Maleic prices have remained subdued since the last 1.5 years. However,
Correct.
We were doing much better margins than the current quarter. So what has changed, given that the industry spreads have also remained the same? Why is the margin impacted to this extent?
So there are 2 reasons. First, reason which I mentioned, there is a compressed margin for last quarter. Second, we were carrying some inventory.
I couldn't get you.
So first reason is there is a compressed margin for the last quarter. Second, we were carrying some inventory which is of higher cost. So that inventory you are carrying at higher cost, that you need to sell as per the prevailing market price. So the result inbuilt the inventory losses themselves. The third point which I mentioned is about the low realization of the Maleic Anhydride.
Right. Could you help me on the first point a little?
Typically, the margin across all segments are impacted because the downstream industries to whom we are supplying, some of them are supplying it to the US market. They were not doing well, so that has impacted the overall demand and the margin. And margin, when I'm saying margin is compressed, it's not just because of Indian market. In the global market, margin has gone down, which indirectly impacted the domestic player also. Okay. So it's the three factors put together. One is the compressed margin. The second is lower realization of the Maleic Anhydride, and third is the high cost inventory which we were carrying. Now that all are settled up to December.
Sorry to interrupt you, ma'am. I would ask you to rejoin the queue for a follow-up question. The next question is from the line of Aditya Khetan from SMIFS Institutional Equities. Please go ahead.
Thank you, sir, for the opportunity.
Thank you.
Sir, during this, now, sir, the remaining catalyst chain for this fiscal year has been completed. When you see like the next catalyst year will start in second quarter or?
I think it is not there in next 6 months. It is not there.
Okay.
It is not planned in March or June. It may be after June, but I don't have exact date today.
Got it. And sir, now we had mentioned like because US market was because of this tariff impact, volumes of end user industries have been impacted. So sir, now what is the negotiations like going on the table? Are the customers expecting an uptick?
I think the volume has already improved because the US matter is more or less settled. And whatever actually if you look at last 9 months, so M2M inventory loss comprises around 40 to 50 crores in last 9 months in the results. So that all matter is settled. Now the prices has already bottomed out, expected to go up. And we are expected to have more than 50,000 ton of the volume every quarter or more than that. And then there will be PA-5 along with the plasticizer, which will further improve the phthalic volume as well as the volume of plasticizer, which will add, if at optimum capacity of plasticizer and PA-5, it will add 1,000 crore to the revenue. But I expect 30-35% on annualized basis. Starting off the plasticizer, gradually it will go up to optimum capacity.
Got it. Sir, on to the DEPs, in our existing plant of 8,000 tons, we are debottlenecking that to 12. Already, sir, we have a 75 ton plant in completion right now. This plant is towards that toxic or is sort of a chemical. Is there any rationale for expanding into this?
There are two plants. One plant I'm talking about the DP which started in 22. That is catering to the fragrance industry, mainly like all type of fragrance chemicals companies like Orient, JD and all that. So these plants which has a capacity of around 8,000 tons, that we are right now doing the debottlenecking which will improve the capacity to 12,000 tons. So that is already under progress, expected to complete by March 2026. And another plant of plasticizer which is under construction, that is separate. That doesn't have a DP. That is actually DOP, DI, NP and other products.
Correct. So for like expanding into DEP, is there more rational like because more customers are phasing out from DEP and looking to other options because of some toxic other.
If you ask me, first there is a better margin, there is a stability in the pricing, and there is a good growth demand. We are not only supplying DP, which is the base for the fragrance for all type of perfumes and all to domestic market, but we also cater to the export market. So for us, I think DP is something which provides greater stability in the overall margin. Right now, we are also at DP 40% of market share. With 12,000 ton, we will have more than 50% market share in DP. DP is a good product. All the perfumes which you are using, like a lot of market perfumes are available, the fragrance, agarbatti and all that. The base is DP.
Got it, sir. Sir, what would be the capex onto this debottlenecking?
It's a 2 to 3 crore, very small. It is not the capex, it will be part of the operating cost only, operational cost, yeah.
Got it. And sir, this new plant of plasticizer, volumes and revenue will flow from Q2.
Q1 will be there, but very small revenue, but yeah, Q2 gradually it will go up in Q2, Q3.
Got it. Sir, with this, with the high tariff imposition on China, so seems like more of material will not go into US and flow into other markets. So Maleic Anhydride, is there any sort of a concern like outside of US the inventory would be very higher? That would lead to further softening prices, or still like you say like this is the bottom in prices?
So the Maleic Anhydride prices, I believe next 1 or 2 years tight, because China has a extra capacity which they are supplying to or catering to the global market. However, with the India and the Europe deal, so, trade-free trade is signed, so there will be a lot of opportunity for Indian Phthalic, Maleic guys even to sell it to the European market. US market has a certain type of deal, but they are providing certain concession to the Chinese market. So Chinese continue to sell their Maleic to the US market and Europe market. So whoever is selling in China and Europe, they need to compete with the Chinese. But I believe that next 6 months to 1 year, there will be a compressed margin. But logically, because today the margin of Maleic is below the cost of production through the butane-route. If you get the butane today in India, it will cost 500 to 550, 300 is conversion, so 850 to 900 is your break-even. Prices are 670. IG case is different. We are using we are getting Maleic from the wash water, so cost is practically nil. Otherwise, if you use the butane-route, Maleic is not viable today.
Okay. So just one last question. So we maintain that our top line of 2,000 crore would be visible. So 1,000 crore of incremental addition on top line and subsequent at 14-15% margin. That could be.
Right now, we have revenue between 2,000 to 2,200 crore, which is roughly 2 lakh crore or 2 lakh ton of the Phthalic which we are selling with Maleic and benzoic acid. With optimum utilization of say 90% utilization of PA-5 and the plasticizer, we expect to add 1,000 crore revenue. If we do a utilization of 40-50%, accordingly revenue will change. Yeah.
Got it. Thank you, sir.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. The next question is from the line of Chirag from Keynote Capitals. Please go ahead.
Yeah, thank you for the opportunity. Pramod sir, my first question is related to the time of spread you were talking about. So just on a competitive basis, on Q1, Q2, were you also specifying Q1, Q2 spread with malic acid or Maleic Anhydride into picture? Because in our understanding, it was like the spread that you always talk about is time of spread. So this $60 to $80 spread that you are speaking about is something new that you have incorporated by specifying Maleic Anhydride into it. So could you give a comparative directional for the specs for Q3?
Can you just repeat your question, because I have not got you wanted to ask the question why the additional margin over and above the market margin is coming from? That is your question?
No, sir. I am just saying that since in last 2 quarters, Q1 and Q2, then you were specifying about the spread, which used to be 100, 120, and last quarter 120, $150.
Correct.
You were talking just about time-off spread, right?
So I will repeat again. Whatever is the market margin, IG used to have 80 to 100 to 120 extra because of operating efficiency, yield byproduct like Maleic Anhydride and benzoic acid. When the market is compressed, when I am talking about it, the margin plus the addition. If there is some inventory inbuilt loss and all that loss, that will be reflected in the financial results.
Okay. So it was the extra that we were earning was because of the Maleic Anhydride and benzoic acid. specifically?
Maleic anhydride, benzoic acid, and the operating efficiency of the yield advantage, all three together.
Got it. And that spread has come down to $60 to $80 for the quarter.
Yeah, but 60, it was for the last quarter. Now it has again improved it, and in our case, it has also got impacted apart from market margin because the high cost inventory, which is now nil because that has been exhausted or sold, and now the prices have gone up.
Got it. So my second question is related to the 4 plants that you are specifying about to run every time in the year, around the year. So based on my understanding, once the plasticizer plant will come up, so we will be using 3 plants for phthalic and 1 plant for plasticizer, and 1 plant will always be shut down. So roughly on an annual.
We will be operating 5 plants. 1 plant, 70% will be utilized for the purpose of plasticizer, and out of 4 plants, 1 plant will be taken the shutdown for change in catalyst every year.
Probably we would be having 2 shutdowns every year, as you specified earlier.
I think I will repeat it again. Every 3 years we need to take shutdown. So if we have a 6 plant, we need to take shutdown, 2 shutdown in every year. Now we have 5 plants. So every year there will be 2 shutdown, 1 year there will be 1 shutdown.
Got it. And sir, this technical problem that we faced during the quarter led to 1 month shutdown for the plant.
Yeah, that has been sorted out and it started again back in December. But that has
what
not
kind of
impacted the
volume?
sale. That has not impacted
What kind
the
of volume we did in this quarter compared to last quarter?
Last quarter was around 47 types, and this quarter was more than 51.
This quarter was 51,000. Roughly last quarter was 46, if I'm not wrong.
So it basically, I don't want to comment directly on volume, but we improved around 10% compared to last quarter. Sales has improved because there was a good inventory line.
Fair enough. And Maleic prices currently is 35% is down compared to PAN prices.
Maleic prices are today is less than $700 in international market. Less than $700, 670 to 680.
And this is because of the excess supply from China.
I think there are multiple factors. It has actually been going down for last 1.5 years from 1,000 to 850, 900, 800, now 750, then now again below 700.
Got it. Just 2 questions from my side. So first is when you are saying that we are expected to get mechanical completion for the plant of plasticizer in Q4, when can we expect the plant to commission completely after the dry trials?
I think generally 1 month. So that's why I mention it. There may be some quantity of production of plasticizers, but that will not be high in April, May, June. But you will see the gradual improvement from July, August, September in production of plasticizers.
Got it. And just last, any update on the CBG plant? It is expected to be completed in Q2.
I think construction is going on. We expect mechanical completion to happen in June 2026. Construction is right now on.
And what is the raw material that we would be using in CBG?
We will be using the napier grass and the agro waste as a raw material for CBG production. Yeah.
And the raw material would be available in nearby areas.
Yeah. It is abundantly available. It is actually the plant is in between the sugar belt and all other belts. It's Raichur is the center place, surrounded by a lot of sugar factories and other factories. Agro waste is available, and napier grass is being grown to supply.
And what would be the size of the plant?
The size of the plant is 5 ton per day. The production of CBG 5.2 or 5.3. It's a pilot plant for CBG.
Yes, got it. Expected to run 300 days in a year.
350, because there is no other problem in that plant. 330 to 350 is the production period. So 1,500 ton in a year.
Got it.
1,500 to 1,600 ton in a year. Yeah. Hello. Yeah.
Yes, that's it from my side. Thank you, sir.
Thank you.
Thank you. The next question is on the line of Nirav Jimudia from Anvil Wealth. Please go ahead.
Yeah, sir. Good afternoon, and thanks for the opportunity. So two questions. So first is on the user industry side, like UPR and pigments were indirectly affected due to the U.S. tariffs because we were doing a lot of exports from India in terms of both these products put together. So if you can just help us understand in terms of the volumes which we were catering to these segments before the tariff and after the tariff, how much of the volumes would have impacted?
So I think pinpoint I can't give you because after the tariff volume is yet to improve, which we will see gradually. Typically, paint, plasticizer and pigment put together is 50 to 55% for us. Paint, pigment and plasticizer is between 50 to 55% put together. Balance is the specialty chemical, DP and other plasticizer.
Correct. No, sir, what I was trying to ask you is that, let's say when the tariffs were in place and when the tariffs were not in place, I'm not talking about the existing situation.
So basically, two segments which were impacted. One is UPR and some portion is the resin and the CPC. So overall difference will be 5 to 10% of the sales. We expect that in this segment, sales will improve by 5 to 10%.
Correct. So let's say if we are doing a volume of 50,000 tons, 2,500 tons were impacted, which should come to us on a steady-state basis as...
Correct. Absolutely right.
Correct. And sir, with reference to the paint which you just touched upon, like a new player, Grasim has been consistently increasing its market share. So are we currently supplying to them? And if yes, what sort of monthly volumes we are catering to?
So typically, we are supplied to all paint companies in India, and the typical volume for the paint companies is around 15 to 20% of our production, which we get
around 10,000.
15 to 20% because it's a seasonal. Sometimes it's 15, sometimes 17. Because in raining season, the paint demand will low, plasticizer will improve. So it changes quarter to quarter.
Correct. The second question is on the imports of OX. So with this EU FTA going, so like EU FTA in place, so from next year onwards, we'll start getting the benefits of the deal. So are we importing anything from Europe in terms of OX so that the duties which currently are there?
We don't import anything from Europe, but there may be opportunity to sell the product in Europe where the prices are good. However, we need to check the logistic point of view. And second is 60% or 65% of product which is being sold for phthalic in Europe is molten. And around 30-35% is on flex. So we are generally domestic market. We produce flex because molten is not easy to transport. So there is a limited opportunity for the Indian player in European market. However, we need to check the commercially based on the logistics.
Correct. And
duty has been made to nil.
Yeah, correct. And sir, last question from my side. You mentioned about 9-month inventory loss figure of close to around 45 crores, if I heard you correctly. If you can just quantify them, okay?
I will tell you. I will just mention that the M2M charges and inventory impact is 40-45 crores, both put together. The M2M was around 25 to 28, and then 10 to 15 was inventory. Both put together was 40 to 45 crores inbuilt in the financial results for 9 months.
Correct. So is it possible to share the inventory loss figure for Q3?
We don't have a direct number calculated for that. It's a cumulatively and it is not reflected in the results. That is how we internally calculate. Because the high cost inventory remain in your books and then you are selling it. Then the loss which is being calculated. So it is inbuilt. There is no separate calculation done by us for inventory. However, for M2M we have already provided in the 9 months results.
Correct. And sir, with the plasticizer plant getting commissioned, currently we are around, let's say, give or take 205,000 tons of volume.
Correct.
So how our volume should optically look like in terms of production for FY27? Any guidance which you can share?
26, 27, ideally it should be between 230 to 235. Out of that, 5 to 10,000 tons will be for plasticizer and DP, and around 220 to 225 should be for phthalic.
Perfect, sir. Perfect. Thank you so much, sir, and wish you all the best.
Thank you.
question is from the line of Madhur Rahati from Counter Cyclical Investments. Please go ahead.
So, Mr. Bhandari, disappointment seems to have become the destiny of IG Petrol shareholders. Every quarter, either there is a planned shutdown or unplanned shutdown or some technical breakdown. So, but the bottom line is that the numbers are really disappointing, and it is reflected in our stock price. The net worth is over 1,300 and market cap is around 1,000 crores. So basically, market doesn't believe our net worth. That's what the means when the market cap is below net worth. So any plans to do share buyback, and why are we wasting money on CBG plant, pyrolysis oil, and other exploring downstream chemistries when our core business is trading below book value? So why not just do a share buyback?
Okay, let me explain you about the industry first. Your comment is very blunt, but let's understand the industry, how it works. So Phthalic IGPL is the largest player of Phthalic. It is a cyclical industry. Please understand that the margins move in line with the international market price. We have expanded our capacity. However, the plasticizer got delayed by some 3 to 6 months. When we start the plasticizer, then we will get the advantage of complete integration of PA-5 and the plasticizer. Coming to your point, the market, the book value and all that, I think that is the one way of looking at the investments, but we are focusing on improving our efficiency. When the market is bad, you can look at how you can optimize our cost, how you can improvise our overall margin. When market turned up, like in Jan, Feb, we see that there is a good revival in the market, the margin has improved. So I don't think the investors should look at 1 or 2 quarter results. And it's not for IG. You look at the entire industry of the Phthalic Anhydride market. So whether company is doing or company is not making money, it's nothing to do with the company. It's the performance of the market and the margin. Company is not different from the market. If market is having X margin, company can have an improvement of $50, $60, $70 over and above.
So, Mr. Bhandari, I understand the point you are making. In fact, you are proving my point that we are in a cyclical down cycle. We have a great future ahead of us. We have expanded capacity, and this is a temporary down cycle. Then that is exactly the time when share buyback should be done, so that all the future growth can get divided on a smaller base.
My dear friend, share buyback decision is taken by the management and the board. You and me discussing can't decide that. That is one. But the other opportunity, you always look at the equity market point of view. I understand your point of view. Another thing which I need to highlight for last 9 months, while we are operating 4 plants, the interest and depreciation is being charged for the 5 plants. So what happened in the last 9 months doesn't necessarily meaning that the future will not be changed. You need to wait for 1 or 2 quarters. You will see a drastic improvement in the performance of the company.
Right. Sir, so why is our interest cost high for the past 2 quarters? If you could just help us bifurcate, is it because of the euro loan that we...
No.
So if you could just bifurcate why the interest cost high?
I will do it. The interest cost is not high. We have already projected for 36 crores. In the interest, in 2024 March, when we completed PA-5, the debt of the PA-5 is also reflected in the P&L. In depreciation and the interest of PA-5, which is yet to start the operation in terms of the production. So what you are seeing is 36 to 38 crore was the financial interest and finance cost. However, there is a minor impact of change in the interest rate from converting into euro to rupee. However, we have prepaid a loan of 45 crore. So that is somehow balance it out. So if you look at the overall interest cost, because we have a treasury income of 20 to 24 crore, effective interest cost in our balance sheet is 15 crore. For a company which is revenue between 2,000 to 3,000 crore, I think this is the fair, one of the best in the industry.
Right. Sir, so if I were to bifurcate the 10.4 crores of finance cost that we did in this quarter, so if you could just help us understand how much was towards interest and how much was towards other charges related to all these factoring and euro loan conversion?
3 to 4 crore rupee was on account of term loan interest. Balance is the working capital charges, LC charges, bill discounting charges and other bank charges. And around 1.5 crore was the M2M for balance 5 million euro loan which is lying in the balance sheet because we have converted 100 crore loan from euro to rupee, but one loan which is 1.1% interest is still in euro. For that, we need to charge M2M, which is reflected in M2M as well as part of interest cost.
Right. Sir, just a final question from mine, sir. At what multiple do DEP and plasticizer realization can we expect versus Phthalic realization? And sir, is it fair to assume that closer to 3,000 metric tons of Phthalic will be used for the expanded DEP capacity?
Correct. So basically, when a DP is, I'm assuming DP is operating at 75,000 tons, then 30 to 35,000 tons Phthalic will be used in that, which is roughly 40% of the DEP. Now, coming to your second question, what is the margin? I am assuming we are transferring the Phthalic at a marginal cost or the lowest cost to the DP plant at which we are selling our Phthalic in the market. If you consider that, then the Phthalic, the plasticizer margin is around 10 to 12% over and above the Phthalic margin today.
And sir, on the realization front?
Basically, realization front, you can assume that right now at 75,000 tons, sales is coming around 950 to 1,000 crore.
Mm-hmm.
So it typically, when you are considering Phthalic as say 90, 91, the weighted average, because there are 6-7 type of plasticizer, is coming between 100, 105 to 110, depending upon which type of plasticizer. Because plasticizer raw material is not only Phthalic, but also the different type of alcohol and some catalyst. So all put together, you can say if plasticizer is 110, then 100 is the cost of raw material for the all plasticizers.
Right. So closer to 3 times.
Including conversion cost, yeah.
And sir, for DEP, what would that number be?
DEP, we are actually more than 12% we are making the margin on DEP. When I'm saying 12%, when I'm saying 12%, I assume whatever Phthalic we are transferring to DEP, that margin is considered in Phthalic. Over and above, we are making 10 to 12% in DEP.
Got it. And sir, what is the revenue from DEP in 9 months, and what was the volume in 9 months that we did for this product?
So DEP, right now we are selling around 1,500 to 2,000 ton in a quarter. So typically, right now, annualized volume is around 6,000 ton for the DEP.
Got it. And revenue?
Revenue at 6,500 ton is around 100 crore. But today, the last quarter, the Phthalic prices and the DEP prices was low. So the average revenue in the last quarter was 15.5 crore.
So, Mr. Bhandari, for next financial year, what is the expected volume of Phthalic?
Which I mentioned, I think you were there on the call. We expect the volume of pure Phthalic 2,25,000. The production is expected between 230 to 235. 7 to 8,000 tons will go to the DEP and the plasticizers, and balance 20 to 225 will be available in the market for sale.
Sir, I may request you to rejoin the queue for a follow-up question. The next question is from the line of Aditya from Securities Investment Management. Please go ahead.
Hi sir, thanks for the opportunity. Sir, I believe the Chinese government had removed the export rebate on Phthalic Anhydride. So have they done similarly for Maleic Anhydride as well?
Sorry, can you repeat your question? What they removed?
The Chinese government had removed the export rebate which they were providing to their producers who are manufacturing Phthalic Anhydride. So has that similar thing happened in case for Maleic Anhydride as well?
No, not yet. I have not seen any publication or notification for Maleic.
Understood, sir. Understood. And I believe that China had expanded this Maleic Anhydride capacities because we are going to implement single-use plastics. So Maleic Anhydride was going to be used for manufacturing bioplastics. So has that got delayed?
Actually, not delayed. They were planning to implement in 22, compulsory implementation. Then they decided to do 25. They further extended the date. So right now, biodegradable is not compulsory by law. It's optional. So because of that, not everybody is intended to convert the maleic into BDO and BDO to PBAT and PBT, which is the biodegradable plastics. So to that extent, the maleic is not being used for biodegradable. They will continue to sell maleic into the international markets.
Understood, sir. And now, sir, you mentioned that currently Maleic Anhydride producers are selling below cost, especially those who are manufacturing through butane-route. So how are the Chinese able to do it? Because I don't believe they have their own butane capacities. So just wanted to get a better flavor. How are they able to manufacture at such a price?
The maleic in Chinese are being produced through butane, and which is an integrated part of refinery cum petrochemical complex. So butane is basically the part of C1, C2, C3, and whatever butane is mixed butane, then they convert it to N-butane and again balanced butane, because in the maleic process, you take 100 kg of gas, use 60-40, you need to again give back to the refinery to pool it with the LPG pool. So around 60% gas is used and 40% go back to the source. So they are manufacturing the maleic, which is a fully integrated refinery cum petrochemical complexes.
Understood, sir. Got it. And lastly, sir, for Phthalic Anhydride, just wanted to get a sense, are the current lower prices, is it because of lower demand or there is excess supply? Just some kind of outlook, flavor you could provide on Phthalic Anhydride.
You are talking about phthalic or maleic?
Phthalic, sir.
I think phthalic, the overall, there was a geopolitical uncertainty, and everybody was under negotiation. So there was a issue because a lot of downstream of the phthalic players like UPR, they are selling 70-80% of their product like artificial marble into US. Because of geopolitical issues, the downstream industry got impacted. That has changed the balance of demand and supply. That's why the margin got impacted. Since now the Europe, Australia, the US deal is concluded, we have seen an uptick in the demand as well as overall margin.
Sure, sir. Thanks for answering my question.
Thank you.
Thank you. Participants may limit their questions to 2. The next question is from the line of Prasad from Kamayakya Wealth Management. Please go ahead.
Thank you for the opportunity, sir.
Yes.
So, you mentioned that the CBG plant will go live from June 2026, right?
Yeah.
And
Yeah.
when does the pyrolysis oil plant go live?
That I think I will not be able to tell you right now, but we are trying to get it before September. Because pyrolysis, the CBGs, I think work is more than 50% over. CBG is under construction, it's given to Praj, everything is settled. Pyrolysis, I think plant construction is yet to start, basic and detail engineering is just completed. So probably
Okay,
next
sir.
quarter I will give you the exact timeline.
Okay. And can you just repeat? I guess I misheard. Can you repeat the spreads that we earned in Q3 on Panox spreads? What are they? What are they at currently for us? Thank you.
No. In the result, the spread which is reported is around $90 per ton, which includes the basically low realization of maleic, compressed margin, inventory excess, high cost inventory, everything is inbuilt. Market margin is around $60 to $80 or $100. Generally, IGPL earned around 60, 80 to sometimes $100 to $120 because of operating efficiency as well as the byproduct. But this time, all put together, there is a pressure on the downstream industry. There is a compressed margin, the lower realization of the Maleic Anhydride, and overall operating performance. There was an M2M in high cost inventory, all put together has impacted. For last 9 months, if you look at the financial performance, it's M2M charges, inventory loss, everything built together, and there was some unplanned shutdown also, which has also cost all has been inbuilt in the results. We expect that Q4 will be better, much better than last 9 months, and going forward, you'll see the improvement when we start the PA-5 as well as the Plasticizer.
Got it, sir. So just one clarification. So the spreads that we mentioned at 100, 120 are what we are earning currently, right, in Jan-Feb?
I will not like to comment it. It's a market margin, and what IG will earn in the quarter, that will be reflected in the result.
Okay, sir. So the market spreads right now are at 100, 120.
Correct.
Okay, sir. Thank you.
Thank you. The next question is from the line of Kunal from Alpha Alternatives. Please go ahead.
So to understand this side, we are at $110 to $130 spread now.
Yeah.
And we do a volume of typically between 45,000 to 50,000 a quarter. And given
We do typically 50,000 50,000 plus minus 5%. Yeah. 50,000 ton.
Assuming there are no inventory losses now and M2M is largely gone. M2M is largely gone.
Correct.
We should expect a EBITDA run rate of 50 to 60 crores every quarter, right?
Yeah.
Sir, also when we say that depreciation and interest is being charged for 5 plants and that is being absorbed by sales of 4 plants.
Correct.
But as I correctly hear you, always one plant will be on shutdown. So does this reason?
No. I will repeat it again. PA-5 will be starting along with the plasticizer. 4 plants will be operating at 90% capacity. 1 plant out of 4 will be shut for 1 month for change in catalyst.
Oh, that is only for 1 month. So
Yeah.
secondly, downstream capacities for PAN, they were downstream industries were operating at 30-40%. Has there any upward trends there?
No. Downstream industry is paid plasticizer, pigment, CPC. We are supplying to most of the chemical companies. When we started the plasticizer, when we are planning to start in March, mechanical completion, and April, May, when we start plasticizer, the volume will not go up in one day. Gradually it will start and gradually it will go up. We expect 30-35% of the volume in the first year for the plasticizers.
So not about plasticizers, are UPR and pigments, which are our downstream industries which we supply to.
UPR, paint, plasticizer, pigment and CPC is around 50 to 55%. UPR and the DP put together is around 20%. Balance is other industries.
Sir, and what would be the reason that PAN prices have risen up 10-15% in last 1 month? Is there any pinpoint reason? And secondly, to understand, are there any triggers in Indian market which will drive the realization more than global markets in next 2 years?
So first question, your question is what are the reasons? So basically, because of the geopolitical uncertainty, there was an imbalance in demand supply, and there were a lot of free trade agreement is being executed between various countries. So that clarity has come. I think most of the free trade for India and other European market has already been concluded. Now US free trade is also in place. So overall demand in the downstream, a lot of downstream industry which were selling it to US and Europe, they were not able to operate because there was a restriction in terms of the duty. Like 50% duty, you can't sell it to Europe, whatever product you are producing. Now with that clarity, the overall production of the downstream industry has improved, which in turn, I'm not saying improvement in demand, but returning of the demand which was subdued because of these reasons. So that has improved. And the second is, it has gone to the level where it's very difficult for the company to recover their operating cost. No product can be sold for a longer period of time below the operating cost, or basically your cost of production. So the prices and the margins has already bottomed out, and since there is a improvement in the sentiment, we have seen the good price appreciation between 80 to 83 rupee to 93 in a period of 15 days.
So lastly, if you can tell us for next 2 years, what will be the capex? Any clarity on subsidy of your old plant? And as your competitor has filed ADD measure to be considered by government, what could be the timelines we could expect for this?
So I think all players put together a file for ADD, which is review is expected to come up in August, September. So it's from industry. It's no one person is filing, it's from industry. We expect overall margin to improve in next 1 or 2 quarters, and we have already seen in Jan and Feb. March is also expected to be good. What was your second question?
The CapEx for next 2 years and subsidy clarity.
CapEx, I think we have a CapEx of plasticizer, which will be over by March, which is, I think we already done 130 crore, around 30-40 crore is pending for plasticizer. CBG CapEx is around 30-35 crore. We are already doing it. So put together right now, for the CapEx plan, you can say around 40-50 crore for next year.
So subsidy clarity, if any?
We have got in principle approval from the government for subsidy, capital subsidy from the government, and we have applied to get the money from government for 24-25.
Okay, fair enough, sir. Thank you.
Thank you. Ladies and gentlemen, due to time constraints, we take that as the last question of the day. And now I would like to hand over the conference to Mr. Bhandari for closing comments.
Dear friends, I think we have discussed the results in detail. Only point I need to highlight is all chemical companies, I'm not talking about IG, is facing some challenges because of geopolitical issues, compression in the margin. But I believe there is a better time going ahead. I have witnessed it in all chemical companies because we are supplying to most of chemical companies, which is 70 to 80%. So we see there is a clear-cut improvement in the margin going forward, and we expect that not only there will be improvement in margin for IG, but also improvement in the volume in terms of the Phthalic Anhydride and Plasticizers. So we expect 26-27 will be much better than last year. Thank you very much for the call.
On behalf of IG Petrochemicals Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.